Okay, so this is the course that we're looking at. This is 804 corporate financial management. So we'll just go through just the way we do it from study session. Each of the, all the courses have different study sessions like that. So we'll go through study session by study session like that. And all these ones are just theory, like just too much talk. So where the course start from here. This study session one. So this is where it started. So we're going to look at the content of this. We're looking at our financial management evaluation, evolution of our finance, field of finance, corporate finance, and financial managers. So this is I already put this like a summary, which is here, right? So we'll just look at it together. So, and I'm trusting God that by the end of the session, we should all be able to explain the nature of corporate finance and the financial management, and also discuss the goal of financial management. And also, we can know the difference between corporate finance and the role of financial managers. So, that is what this particular uh, course or this study session we are looking at. So, now the first part of it is we look at the financial management. Now, we can just, in the very simple way, we can say that financial management is about managing an organization money efficiently. You understand? Basically, that's what it means. If you go to that book material, it's saying the same thing. But then this is just in the very simple thing. When somebody asks what is financial management, it's just about managing an organization's money efficiently in a very beautiful way, nice way, how we will be able to pay things, how we're able to, so it's involved planning, controlling, and allocating our resources for maximum benefit, right? So this covers valuation of asset, risk management, investment, financing, and dividend divisions. So I put like kind of decisions, sorry, and I have. So let me make this fine. So, it like a practical example that I put here. Let's assume like a company want to launch a new product. The financial manager is going to evaluate whether to fund it using savings, right? That is equity, or borrow money, that is debt, and then they will calculate their expected returns. That is how much they're going to get at the end of the year. How much? So sometimes you can just so by the time they do this, they can actually uh, so expected returns is can be a it can be fixed, or I can know what I'm going to get based on my calculation, but I can even do I don't know exact amount. I can also do what they call projected return. So we can project that, okay, if we actually borrow money and do this business, this is what will come back to us. You understand? So all these things are just inside financial management. So we go down to the so if you look at the structure of the course from with the model where we are coming from, right? We'll start from this. You know what I mean? What I mean by this, by that is this guy. You can say financial management. It's just a process of just managing organizations' money. And then from there we'll look at evolution of finance. So that is where I was looking at. So in this one here, we look at the first one is the if you go to the course material, you see this. We have the traditional phase. It starts from 1890 to 1930s. Yeah, I think some of us were very small at that time. I was very small. So, so this actually this by this time, people actually focus more on raising capital and maintaining liquidity. And then we have the stage two, which is here it is a transitional phase, which is in 1940 to 1970s. We look at the financial analysis tools emerged. So by this time, people start looking at the sophisticated way of managing finance. So we also now we are in the modern we are in the modern world phase of accounting or finance management. Now we have that start from 1980s to the present world now, right? So Here we now focus on the global financial market, efficiency and optimal risk.
Sorry, you've been breaking. Shannon,
Yes, sorry. Can you hear me now? Hello?
Shannon,
Please,
Yes.
you've been breaking. We can't
you've
hear
been
you.
breaking. You've been breaking.
Dang. Great.
Shannon,
Yes, yes, I can hear. I'm checking my network.
for like almost
Sorry, guys. Sorry, I didn't know. Okay. Hello? Can you hear me? Then I just start with network. Why did network just decide to be bad?
Is anybody in the house?
Hello? Yes.
Can you hear me?
Can you guys hear me now? I'm back. I think. Is it
Yeah,
better now?
yes, we can. Yes, it's better.
Thank you very much. Okay, I'm sorry. I didn't even know. Thank you for calling my attention to that. So this is actually like if you look at it, the evolution of finance, we have like the majorly we have the three phases. We have the traditional phase, and we also have the transition phase, and we have the modern phase. So the first one was from 1890 down to this level. All these are just theoretical part of the whole course. So we can just check that from the material. And also, like I always do, I will send this summary back to you guys at the end of this meeting. So if you want to use it for your reference, fine, you can use it. But the reason why I do this is just for me to be able to explain it in the best way that I can. Because if I want to go by that material, just like I'm still reading the note for us where you can just go and read by yourself. Okay, so we have the field of finance, we have the public finance, which is like the government revenue and spending management. We have the security and investment analysis, people that manage portfolio for risks and returns. And we have institutional finance, that is the banks. We talk about people like the bank, the pension fund, and insurance. We have international finance, which is these people they handle transactions between countries. Yeah. So we have corporate finance. We have people that manage companies' money for growth, profitability, and sustainability. So all these things are just like the let's just say careers. The way can I like as a financial manager now, where should I be looking at? Where can I work? So they are actually the field you can have jobs in. So we have like the public finance, security and investment, we have the international. So I like just like example, I just want to yeah, it's like I want the class to be more engaging because we are all studying together, right? And so for this one now, uh this particular one, let's see from here down to this level, from here to this level. These are about five, right? We have the public finance, institutional finance, and so I just want you guys to give me like one example of okay, one example of each of these institutions of this finance, the field of finance, like the organization that you know that handles such this. For instance, if we're talking about like this one, we're talking about banks. So maybe we can just say Zenith Bank. Yeah, I know that Zenith Bank is kind of example of institutional finance. So we can so on the pension funds and insurance, you just give me like one more example for each of it. Anybody?
Pension fund, we have PAL, and then we have Stanbic IBTC. And
Okay,
also, I say we have pension fund, we have PAL,
okay,
Stanbic IBTC. We also have AXA Mazda for insurance, and then Leadway. All these are companies that handle pensions.
Okay, nice. Thank you. Another person can go for another one. Okay, so let me just like so that we not waste our time, right? So if you look at the public finance, we're talking about the government revenue and spending expenditure. So now, just like we have like just to give us an understanding, uh, this is just where government actually, government is in charge of getting tax from personal tax or employee tax, taxing companies, and all that. You understand? So this is an example where government collect tax from citizens and businesses. You understand? So it uses the revenue now. It uses the money for the tax. Now this is like a government that I'm talking about. A government uses money for use the revenue that they generate through this middle to like build the roads for us, fund schools, and pay civil servant. For a civil servant, that is where your salary comes from, right? So your money can come from there because government get money from what does it get the money? So I'm just giving an example of tax. Tax is actually so when talking about tax, the body that manage tax in our country, they what we have the FIRS and the internal that is Federal Internal Revenue, I think, something like that. And then we have different examples. We have on the public finance here, we have the Federal Internal Revenue Services, and also we have there's one other office I saw, like the DMO. I don't know whether you guys are aware of that DMO. I saw that building somewhere. So it's an institution that manages government debt. They are the one that are in charge of borrowing money. Understand? It's debt management office. So they actually oversee the government borrowing. You understand? They help government to borrow money and all that. So they are just different examples. And then if you go to this security and investment, here now, basically what happened here is where investors, right? An investor buy stocks. Like you now, I can decide to do like if I have an app on my phone like Cowrywise, where I have like currently I bought I invested in some businesses on that app. Do you understand? So that is so all those kind of companies they actually handle that for you. But CarryWise is not the company that handle that. They are just an app that connects you with all those companies. Like I can you can think of companies like just like things person called we have Stanbic. Stanbic has uh, a pension this thing too, and also they have an asset management part too. Stanbic, I think I remember that they have an asset management body that get your money. So what actually here they offer you mutual funds, right? They offer you mutual fund and also manage your asset and all that. They help you to build portfolio, invest. So investment here, just so many things that happen in that. But then in this one here, I can think of international finance handling transaction between countries. We can think of something like, can somebody give me example? Okay, let me think. Let's say, do you know about Bank of Industry? BOI. Any of you know about that bank? Bank of Industry.
Yes, we have heard about Bank of Industry before. I think
Yeah, so I think now Bank of Industry, what it does for you, it actually focus on industrial financing. So it actually support project with international linkage, like importation of machines, production of export and all that. That is what that bank does. So it actually help the government to manage between, like for instance now, let's say Nigeria and China. Bank of Industry handles such kind of stuff. And we also have Nigerian export and import bank. We have and that is that NAXIN. It's a bank, it's a body. Go to Abuja, you see that. So they actually support import and export and import of importation like that. They also handle foreign trade and all that. So you see, so this is for this one. So for this one, we already know there are so many. We have like the bank, we have Zenith Bank, we have First Bank. There are so many. Is OPay also an institutional finance or OPay? Can we call OPay? I don't know. I think OPay just like a fintech company. I don't know whether it's, but it's actually cool. So we on this one, I'm just giving you guys an example so that now with this example that I'm giving to you guys now, that we are giving to ourselves, they just the example we are having, they will help us to actually remember these things for real. They will help us to remember these things. They say we ask about the field of finance. We know if I remember this, if I remember FRS, I will now remember about public finance. If I remember this, let's say like Stanbic Asset Management, I will remember this. If I remember this one, all this it's just the example help us to remember things easily like that. So for corporate finance, we also have this one help you to help managing a company's money for growth. So with this one now, we talk about people like Dangote. I just example that just come to my head. See Dangote. And somebody asked me why I call Dangote there. It's not like it's a corporate now. Dangote is big thing, right? So what happened here? Like I said, they help managing of companies' money, right? So sorry, sorry, I was drinking. Sorry, can you hear me? Sorry, I was drinking water. Can you still hear me? Hello. I don't know.
Yes, we can hear you. We
Oh,
can hear you.
okay. Thank you very much. Thank you. So now, first, let me just give you like an example in this corporate finance. Let's just imagine that I have a text like I just started the company now. It's a take let's say I have a take startup now, and then I decide whether to use profit to expand my operation, or I can invest this money into a new product. Like maybe I want to build a software or whatever I want to do it, or I can decide to pay dividends to shareholders. So what happened here is the corporate financier will help me that will help my company to raise funds through like maybe it can help me to raise money through loans or plan budget for me, analyze my profit, and also help me to make strategic decisions. So that's what these guys they do. It's the corporate finance. So they manage such things. Help you like that. So I don't think of Dangote and all that. There are some other bodies like that that are in charge of stuff like this, right? So we have the corporate finance and the financial manager. Now, a financial manager is responsible for raising funds, allocating resources, and planning profit and understanding the market, right? So their decision affect companies' growth, profitability, and survival. So the forms of business organization we have the sole proprietorship. If you want to register your business, I don't know whether you have ever tried to register a business on CSC, right? They will ask you these questions like this. They want to know whether your business is a sole proprietorship or a partnership or a corporation. So what this means is on this business, you own by one person. I am the sole owner of my business. So it's owned by me, and so it's easy to actually set up this kind of business. But the partnership business is where two or more owners they share judgment, the risk. So if somebody in this manner, in this form of business, If one person does not agree on something, you don't have to just go ahead with that. But here I can make my decisions. If I want to buy a machine now, I can just buy it. If I decide to, I'll pay my staff 200K. I'll pay. I don't have to ask anybody because I am the sole proprietorship of my business. But when it comes to partnership, two or more people own the business, so they need to share everything. They need to make decisions together. Each person happy to understand that, okay, yeah, I have to do this. Yeah. So these three, right, three of them. So this one is corporation, legal entity, limited liabilities, and perpetual life are also heavy regulated. Okay, so sorry guys, do you understand this part? This is your forms of business organization. Very simple, something.
Yes, yes, we understand.
Okay, so we have the goal of financial management. So I'm having a meeting. Okay, so we have the goal of financial management. The main goal is to maximizing shareholders' money, not just profit. They are what he had, like, just to make these guys rich. So what happened here is the financial management function in these three aspects: the financial decision, investment decision, and dividend decision. So here it's where and how to get money. Where are we getting money? Financial decision. It handles, like, it talks about where and how to get the funds. And then the investment decision now, where to deploy funds for maximum return. Where can we deploy our money to? Where can we invest? Dividend, how much profit to distribute best? Reinvestment. So these are the financial management functions. So we have self assessment here, right? So with answers, I've answered them. So if you go to the course material, you'll see we have some questions here. Like, if you go down, you see that we have some questions. So the material has more. We can see all these things that I'm saying there. That are also here. Together, they're also here. And all this stuff I'm saying, they're also here. I just make it so hard to for easy understanding. But if you want more detailed reading, you can come to this guy and read. But for me, sincerely, whatever I have here, I read here. If I understand it, to write it is not an issue to me. You understand? So, like this one, to write it is not an issue. And that's why I try to see how we can put examples so that by the time you write small and give a practical example, the person will say that, yeah, this guy really understand this thing. He have seen it in reality, and they see know what he's talking about. So even if I write small definition, but I give a good example, they'll know that this guy have a good understanding of what he's saying. So they say you should define corporate finance. So you can see. So this is just short example. Just short definition that can just help you to understand that. You understand? Simple. So these are questions that you see in the course material. If you check it very well, you see them, and the answers are here for you. But you can still read more to write more. But right. So we have the practical scenario, like the business scenario here. So let's assume a startup want to expand their operation. So the startup is just like, they just start a business. So they will have a financial manager that will first of all evaluate whether to take a bank loan or to look for investors. You understand? So the financial manager will have to make such decisions. Then he will check, he projected the cash flows from the expansion. Understand? So he will look at, okay, if we invest this money and we grow this big, how much is going to come in? That will help him to know how much he is going to even promise people that, okay, yeah, this is what if you give us this, we give you this at the end of the day, right? Stuff like that. And then we also have he will decide on dividend payout and reinvestment. So You can see he's doing, first of all, he's doing financial decision, investment decision, and dividend decision. So this is just what it's answer for these things. So in the same module one, we also have study two, which talk about the corporate financial report. Now, in this study session, we want to understand. We'll try the objective here. What we need to do, we need to understand the corporate financial statement and reporting, and also learn how financial information is used for decision making. Right. So we have the key points here. The key points here, number one, is financial reporting. It's help to communicate company performance to stakeholders. You understand? Investors, bank, government, employees. Understand? Does company actually communicate their financial status to employees? I don't think so. Maybe that is the management part of the company, but they don't really share it to the small part of the company. They share it to management. But then, yeah, the report here, so they can it can be a weekly report, it can be a monthly, it can be yearly. Gets and from the other course, I think I was made to understand that reporting usually have to come uh, it's for like a good standard. It's supposed to be a kind of a daily report, so that you know how to compare everything at once. It will be too heavy for you, especially for a business that is running. It is running every day, and the operation is high, and the inflow is too much. So if you are not doing your report every day, you do every day, you do weekly, you do monthly, you do yearly. So I can't say, okay, I will keep everything, I will not do it at the end of the month. It will be too much for you, right? So yeah, so it's nice stuff. So the financial reporting is just a way of communicating company's performance to stakeholders. Now the stakeholders here are investors, banks, government, employees, anybody you think is a stakeholder, let them know. And it can even be people, it can be an individual that you want to, they make the person have money. I want the person to borrow you, right? I will tell the person how much I'm making, how much I'll make, and all that, so that the person can borrow you. So it can just be an individual, but then the person, they automatically are making that person a stakeholder too. And then we have a statement. Statement include the balance sheet, the income statement, and the cash flow statement. We have seen it in which course again? The other course that we are doing the other day. And we have the financial ratio. This is a tools like liquidity ratio, profitability ratio, debt ratio. It helps to analyze the financial health. All those things, I think there are some formulas we're going to be looking at it about it later. So, for instance, now it's an example. Now, if a bank wants to lend a company money, it will look at the current ratio, right? That is the current asset that the company has. So, if you go to the bank now to borrow money as a business, they want to look at the current ratio. Like how much, what do you have? Understand? They may not look at what you have in the account, but their assets. Understand? How much do you have? So they look at so the current ratio here means your current asset plus your current liability to assess the company's short-term liquidity. So that is when they look at that and it actually get to like they will actually have a benchmark. That's okay. If the person have this, okay, the person is qualified for the money he's asking for. So let's give him. But then if they look at it and they'll be like, no, you know the way we see this, you don't qualify for this money. They will not give you. You can now start asking for friends, ask friends to give you money so that you can pay them back. Still fine. So also we have some assessment that are there. So we ask you the users of financial statement. We ask you for the user. We have the managers. We have shareholders. We have the investor. We have banks. We have suppliers. We have employees and government. So all these guys, they they are the users. They use it. They make use of it. Really. And we have the key ratios there. We have current ratio, the quick ratio, and all this. So somebody is going to ask me a question. Can somebody ask me a question about this? What's this? So all you guys understand that? That's me say. I want somebody to act. You guys should be paying attention. So, like I said, so these are just basic. These are going to be. By the time we go down, you're going to even understand them. A whole lot of heavy formulas are going to be going down here. You understand? So this is the ROCE is return on capital employed. You understand? So it actually helped the company to measure how efficient the company is using its capital. That's the money they invested into the business, the money that the shareholders gave to them, or the money they are owing people. So it will help them to generate profit. So by the time they use this formula, I think the formula is down. Don't worry, I'm forgetting the formula. But once you get there, I'll show you the formula. It's very simple. It's formula that are helping to just calculate the capital employed. From the capital that they get, we just help them to. That's the meaning of this guy. Return on capital employed. So this this other one, the EPS, right? The EPS is just any per share. That's the meaning of that. EPS is any per share. And this one is
Okay.
okay, sorry.
Sorry, please. Some of us we don't have background in management, so this concept of ratios, current ratios, quick ratios, and
Mm.
as it is, I'm finding it difficult to grab. Please, can you still throw a little more light on that?
Okay, the ratio here, all these ones, right?
Yes.
This one. Okay, so now these are just the ratio here, right? They are just setting. Let's just say okay, there are certain formulas that are used to calculate some certain things. For just like the one I'm explaining this one now, like this one now, right? Just the way I'm talking about this one. The person is asking the question. I hope you can still hear me.
Yes, I can hear you. I can hear you.
Okay, so now if you look at this one now, we have. I'm talking about the current ratio here. It will help. For instance, you want to assuming you want to start a business and you come to me to give you money, right? I want to know the current ratio. Now the current ratio here means it's helping me to it's helping you now because so before you come to me, I'm not the one to do that for you, right? Let's say you need money for a business. You need to know your current ratio. It will help you to know how much you're going to how much you have in short term, like that is the money you actually have, your liabilities, everything. So now that's what the formula for this now. I think let me use Excel to just show you what that means. Okay. I hope you can still see my system, right?
Yes, I can see.
Okay, so now the current ratio now, the formula is something like this. I am just thinking what I saw. Current ratio is equals to. So just example, just the understanding I have is the current ratio is simply mean the current asset divide by your current liabilities.
Okay.
Liabilities. You can see it's a formula, right? So now let me give you an example. Let's assume that your current asset now, you are already in a business and you are looking for money to expand the business. Yeah. So now you come to me to add you money, to give you money, to get the point now. Now I will now ask you that what is your current ratio now? So you tell me that okay, you currently now you have asset of about 2 million naira. That is your asset.
Okay.
Your asset of
Mm-hmm.
is it 2 million? I think it's more than 2 million. This is two. This should be 2 million now. Yeah. So this is your asset.
Mm-hmm.
Your asset is 2 million, and then you'll be like, okay, your liabilities. You know what is your You know what is liability now?
Yeah.
Hmm?
Yes, liability. Yes, I know.
Okay, fine. Okay, so now when you have, let's assume that now your liabilities are now your. Let's say you have your liability like 1 million. Okay, 1 million. So very simple for you to know your current ratio now is to say, okay, your current ratio is going to be 2 million divided
1 million.
by 1 million. Thank you. By 1 million. Sorry, by 1 million that you have here. Then you have two. Now, what does the two mean? Now, what this means is that the company has two naira. Now, assuming now this is in naira, you have 2 million naira in asset and you have 1 million naira in liability. So this what it means, what this is telling you that your company has two naira of asset for every 1 naira of short-term liabilities. You don't understand what it
Okay.
means. So every now, what it means, like you have 2 naira assets. You have your asset is now is 2 naira for every 1 naira of short-term liability. Now, in a general form, now a ratio of above one is generally good. If your business have a current ratio that is above one, is good.
Mm.
I saw that in a book, not in a financial, but I saw it in a book. It's good one. Do you get?
Okay.
So that is
Mm.
what all those things mean. So now the other one, where was I
So
again?
to a layman now,
Okay, yeah.
somebody's asset is 2 million naira
Mm-hmm.
and the liability is 1 million.
Mm-hmm.
By implication, it simply means that if personally, if I want to assess that company without putting this formula in place,
Mm.
it's like you are the debt you are owing, the depreciations, the value of your assets.
Okay.
Okay,
Yeah.
everything accumulate together.
Mm.
You take out 1 million away from it. That means you are left with 1 million naira.
Exactly. Thank you. That's what I mean. So now this is exactly how in a layman understanding.
Mm.
Because you know that asset is anything that I have, understand that that is of value for me that I can actually, if for instance, if I give you if I'm actually owe you 1 million naira, do you
Mm-hmm.
get, you can come and say,
Yeah.
okay, I'm going to take, so in this asset of 2 million, I can get my 1 million naira from it. And what you
Yes.
have back now is 1 million. So you
Mm.
own now, you have 1 million naira. That is, so me, you are giving 1 million. If you don't give my 1 million this time, I'm coming back to take the 1 million from your asset of 2 million. Then what you have is 1 million.
Mm. Yeah.
That's what it means. Do you understand that ratio now? It's very simple. Current asset divided by current liability. It will give you your current ratio.
So using this example you are saying now, since the current ratio now,
Mm.
if you divide it, you have to, and say if it's greater than one, it's
Yeah,
good, isn't it?
if it's above one, it's good. That means the two is good already, right?
Mm.
Because
Yeah.
if you even take 2 million, 1 million from me, I still have 1 million that can sustain me for a while. But if it was not something, so I can, if I look at it now and be like, no, guy, I cannot give you my money because your liabilities are even more than your asset. But now,
Mm.
if I give you another 1 million, I know that I have 1 million inside that 2 million asset.
Yeah. It's
That's what
okay.
it
Thank
means.
you. Mm.
Yeah. So we also have the other one. This one is the quick ratio, right? We also have another one here. So this one basically is like an acid test of the ratio. So it helps to, this one measures a company's ability to pay short-term liabilities without relying on inventories. Do you understand? So what this means is, now this one too has a formula, right? So the formula is like this. So the quick ratio is equals to uh, the current assets minus the inventory, and then divide everything now by divide this by the current liability. So now, for example, just like example I gave this guy here. So let's assume that I have an asset of 2 million, and then my inventory is about like 500,000. You know what is inventory, right?
Inventory.
Yes.
Inventory, is it the income that you received or something?
Okay, so the inventory here, for instance, you said you have assets, right? And they have asset of, let me give you an example now. I have a startup, which let's say it takes to a startup now. And then I said my asset is about 2 million, like 2 million. So that means that 2 million, it is the money that it's not like it's cash. but it's value of the things I have. That means it's talking about my system, my office, all the system I have in my office for my staff and all that compared to 1 million. Now I have another system that I've not started using that I install. Do you understand? I have
Mm.
calculated my inventory now. I have them. So this is what I have. Let's say I have a system. I have if I come now, I can count okay. I have one, two, three, four, five laptops, seven. I can count them as okay. This is my inventory. Do you understand? And the one laptop is like 800, 300,000. Another one 300,000. Another one so. I want to give an example of so this guy that has this company now, he have 200, 2 million naira as asset. He have the ability of another of 1 million, and then he have inventory of 500,000, like this, something like this 500,000. So he will going to this is divided by the liability money that is having. This is going to be the current liabilities. Liabilities, yeah. So now he can answer okay. I will do the formula now. Let's do the formula now. Equals to the 2 million naira is the asset, and then it's going to minus it with the inventory, and then divide it by the liability. Then divide it by the liability. I have 1.5.
Okay. Yeah. So what's the significance of that?
Sorry, can I come again?
You say the quick ratio now is current asset minus inventory divided by the liabilities. And when you use those figure above, you have 1.5 as a quick ratio. So my question is, what does it signify? What is
Okay, now the quick
the
ratio here now of 1.5 means that the company has 1.50 naira in his liquid asset for every one naira of short-term liability. Now, since it is greater than one, the company is considered able to pay its immediate debt. Anytime, if I borrow this guy now, he can pay me without now. He can pay me without relying on his selling inventory or what he has to sell. Do you understand?
Yes,
So
I
if
do.
you look at this one too, it's still above 1.1, so it's like 1.5. Do you
Okay.
understand?
Okay.
So
Okay.
this is just like it's just the same thing with the current ratio. But now this one, now I have an inventory of what I have that I can sell. You understand? So I can actually
Yeah.
give you your money. I'm not relying on this thing that I have in store, but I can still give you your money.
Mm. Okay.
That's what it means.
It's okay. Thank you.
Yeah. So the other ones that are here, so just pay attention. So this other one was the one I was talking about, the return on capital employed. So I have the capital that I've employed and all that. So how can you do that? So this one to have a formula, right? So I have a formula. They have a formula for this one too. And
Okay.
yeah, check. Let's check this. This should be CE is equals to. So now this is basically now this one, like I said, this ROCE now it's return on capital employed. So it means it helps you to measure how a company is using its capital, that is money that they invested by shareholders or people they are owing them to generate their profit. You understand? I give you money. So what do I get your money for? I get the money to invest into my business and make profit. Do you understand now? So
Yeah.
now what happened is that the formula for this is mean I it's like it's any before interest. Earning before interest. Uh, earning before interest. In the formula. Just check the formula. Formula is escaping my head. Let me check. It's formula for okay. Okay. They said the formula for return on capital employed. Okay. So let's check the formula. These guys they give us the formula. Forgot the formula. Once I write the formula, I'll give you example that can explain that. Okay. What this guy doing? How to calculate this? Yeah. Just increase this. I show basic. I show fee. Is it not one? It does increase it like 20 or 25. Okay. 25, 20. Okay. Okay, so now you see the formula they give you, like, it's really, really crazy. Yeah. Now, if you look at this formula, it's they are kind of trying to break it down. If you look at what you have here, and NOP Now, if you look at that formula for this one is ABIT multiplied by 1 minus tax rate, right? And then for you to get the capital employed, it's going to be so if you look at this formula, this is capital employed. This is what is here divided by this, right? So now for you to get this, you have to get this, and then for capital employed is total asset minus current liabilities. Do you get the point?
Mhm.
So it means
Yeah.
this. So by the time you minus your asset with your liabilities, you get this. Then for you to get this one now is the meaning of ABIT.
No,
That is what I just
that's
typed.
one.
Earning before interest.
Okay.
Do you understand?
Earning before interest.
Yes, earning before interest. That's what I was trying to type there.
Okay.
Yeah. If you check
So what's the meaning of that NOP?
this
Well,
one.
this is earning before interest you are typing.
Yeah, I want to say this earning before interest and
Mhm.
also tax. Earning before interest and tax. That's what it
Mhm.
means. So as a percent, this is as a percentage of turnover or revenue is a key metric that help assess a company's operational efficiency and profitability. That's what
Mhm.
this means. Right. So now the formula I was writing here, I was telling you. So now this looking at this guy's formula, not this guy. Okay, this guy. So this guy is telling you that your 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 ROCA is this. Now this is equals to this.
Mhm.
That is what they say. NOP8 is also known as this. Earning before interest after tax is a numerator, which is subsequent dividend by capital employed. This is crazy. This is really crazy. But then the formula here is very simple. Now let me just solve it. Without this formula, let me just from here I can get the formula I was looking at. Yeah, I just don't say. Okay, so sorry guys. We now have okay. So let's do this. Any before interest and tax is going to be. So by the time I give an example, we can grab that is and tax and tax. Okay. So this is going to be uh, multiplied by 100 percent. Multiplied by 100. Multiplied by 100. And then you divide everything here like this. Everything here is divided by capital employed. Capital employed. So I said the capital employed simply means uh, your current asset minus the current liability. That's what it means. Like that. All together. So let's use a simple example. So if a company has like 500,000 in the capital employed, I have 500,000 and earns maybe 70,000 naira. You understand? I have 70,000 naira or 75,000, sorry. So assuming a company now has like 500,000, yeah, this is 5 million.
Mm.
Okay, this is 500,000. So the
Yeah.
500,000 here, I said, is going to be like the capital employed, right? So this is going to be the capital CE. So I can put this out. Capital employed is 500,000. And they have the EV 7 75,000. So 75,000. So it will be easier for us to calculate. So first now a question is given to you most times. When a question is given to you, they actually state these things like this. So all you need to do, if you know the formula, just do substitution and you'll be able to get the answer. So this formula I just start here now. Right? This formula I just wrote here. It just what I have here, the parameters I have already answered this question. So what I would do here, all I need to do now, I have 75,000. 75,000 here divide by is going to divide by 500,000. Then it's going to multiply everything by 100.
100.
Right. So let me do the maths. Equals to this divide by this. That is like this should be given like 15% multiplied by this multiplied by 100. We give it like 15%. This is like 15. Give like 15%. So now what this means is that the company operates 15% profit on the capital it uses. As 15%, it operates on the 15%. It's going to generate 15% profit on the capital it has. Do you understand? So I have 500,000 as my capital. So it means I'm going to be getting profit of 15% for this capital.
Okay.
Do you understand?
Mm. What is the threshold?
So now you should know if you look at it now, what you have here now, we have a percentage, right? So what it means that if we get the higher ROCE that we have, it's usually
Mm.
efficient. It's better efficient. You can actually say because now if you note what this return on capital employed is telling, you want to know how efficient the company is using its capital. Do you understand? So if
Mm.
I have 50% profit, it means wow, we are very efficient. So the higher you get it, the higher your efficiency is. That's just what it means. This is like very financial terms. I hope you are doing specialty in finance too, or you're in marketing.
No, I'm not even in marketing. I mean, human resources.
Oh, HR. Okay, okay, yeah, yeah. Okay, some of us we are doing. Uh,
But I think I would have loved to do this. Some of us has science background,
okay,
and
yeah.
we are not in this field before.
So one of the ratio
The
here again,
different.
it's an EPS. Now EPS here is any per share, right? So now what this guy does for you is he help to show the portion of the company's profit allocated to each share of stock. Do you understand? So it tells
EPS.
investors, yeah, EPS. It means any per share, any per share. So it will help to show the portion of the company's profit allocated to each share of the stock. So it will actually tell investors how much profit they will earn for each share they own in their company. In my company. Now, if you want to buy shares in my company, let's right now we say somebody is selling share and all that. Now, this will help me to know how much I'm going to make, how much I'm earning. If I buy 200 shares, this will tell me
Mm.
I'm earning per share. Do you understand? That is what the meaning of EPS. So this one too has
Okay.
it has a formula, and the formula for this one, I know this formula back then because I buy small shares with all this app. So they have those things on their app so they can help you to see. So
Okay.
the EPS, just as now, it's when it comes to if you go to the app, they don't make it complex the way book make it looks like. Because they already have something that calculate this and show you everything. So a system already show you everything. But basically what it means is the EPS means if I have the it's net profit minus preferred dividend from the app. Okay. Minus dividend. I just say dividend. 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 And then divide it. You are going to divide this guy. Divide this thing by number of standing standing shares. So now I'll give you an example of what this means. Now what this means is let's assume that a company owns I have a company that earns 1 million 1 million naira net profit. That means you have a company that earns 1 million naira every. This is your profit of 1 million. Yeah. So this is my profit. I earn profit of 1 million naira. Yeah. So now what it means is I'm selling. I sell. Okay. I have about 500 shares that I want to sell. That's me. My business now. I have about 500 shares of this. That's why somebody will say this bank is selling shares. You can go to buy. They'll ask you how many units do you want to buy. So if I'm selling 500 shares, it means that I cannot sell you more than. So if you come to buy, I can say I'm selling shares for 200 naira, 200 naira per unit. So a unit can just be like one share. So I have 500. I have 500,000. Yeah. I have 500,000 shares that I want to sell. Only one person can actually buy everything if the person has money because I can say I'm selling my shares for 1.5. So I can just share the whole stuff. Everybody just buy. So if you say you want to buy 4 units, 1.5 times 4, that is the money you pay. I'll give you 4 shares. So now you want to know. So now I want to know how much I'm going to sell my share. So for instance, if I'm making 200, if I'm making 1 million naira as a profit in my business, I want to know how much I want to charge for my share. I want to know. So what I will do now, I will say, okay, since this formula said net profit minus dividend, right, divide by the number of outstanding shares, right? So for instance, here now, let's say I have this. Now I have profit this. So I will now say, okay, equals to 1 million. This is 1 million here. 1 million divided by 500. 500. This gave me 2 naira. So this 2 naira means this share that I have of 500 now, I'm actually going to sell it for 2 naira. Each share is 2 naira. So it
Mhm.
means that each share, each shareholder will earn 2 naira profit per share every year. This is not how much I'm saying now. This is how much they are going to earn per share. So if you buy 2 units of, you are buying it 1.5. But if I'm going to earn 200 naira per share, I cannot buy that share for 500. As you can calculate your investment, but it's long term stuff. So you can even
Mm.
decide to buy. You can know that because the money is actually going to be changing. As the profit of this guy is changing, your share is increasing. That is actually what, because if I'm buying share for this guy for 2 naira, right? I'm buying a share now. The profit now, the guy's profit is 1 million naira. And if his profit moves to 1 billion, my shares increase automatically because the formula is static. It's just like that. So the way you keep your share, your money will be increasing, be increasing. And the business will be making money. As people are buying shares, they are using that money to invest, make more money. And they are making money. All the people that buy shares, their pocket will be increasing. Because if you buy a share now, 200 for even 1.5, and by in the next maybe 10 years now, that company is making like 10 billion naira, you know that you have made it. Because it will no longer be the same. It will like, share you get now. Mhm.
Yeah.
So it's your money will be increasing like that, like that, like that, like that. You'll be making a profit. So
Okay.
it's
That is
just
earning per share.
yeah.
Okay, but from the formula you gave, you said is net profit minus dividends divided by the number of
And but like from
outstanding.
the example I gave to you now, there was no dividend there. That means it's not given.
Yes, yes, yes,
Exactly, it's
yes.
not given.
Okay. So, but in any situation that dividend is given, you need to subtract it.
Yes, exactly.
Okay.
So all these things are just like it's too much maths, yeah. But it's not math that can kill you. They are very simple. They are practical stuff actually. If you pay attention, they are
Mm,
practical stuff. Yep. So we will continue, right? What's the time? Have we spent so much time already? I think we still have some time, so let's use it. But I hope it's not just one person that is following me. Other people are following too, right? Rejoice, are you following my class? Okay, I think it's just one person that we are doing this class. It's fine. We'll just continue.
but others are there, sure.
Yeah, people.
You can see we have about almost one, two,
We
three,
have
four,
about
five.
four persons, like
Yeah.
one, two, three,
Mm.
four, five. Yeah, about five people.
Yeah. I think they are following too.
Okay, hope so. So we also have uh okay, so that was so we have the corporate financial information. It's analyze and interpret corporate financial data and all that. So the key point here, we look at the financial info is used for budgeting, investment decision, assessing profitability and risks. So the tool
Okay.
is sorry, yeah,
Sorry, sir.
mm,
For instance,
yeah,
like the topic you have treated and
mm.
some of the sample you have resolved, will it not be wise for us to look at some of the past questions and then try to resolve it so that will put us in a better position to know the direction to go? Or what do you think?
Yes, we do practical, we do examples, we answer past question papers for some of the other courses. Even this one, we are going to do past question paper. Even this
Okay,
we do past question
okay,
paper, we solve it and submit. Say
okay,
exam.
okay,
There's some of the courses are already saying the this thing,
okay, okay, okay.
this yeah.
No,
So like okay,
thank you, sir.
like this one is if you look at this one, it's a past question paper for this is a past question paper for 806. That is I solved it. This is solution, right? So we also
Okay,
do the answer. This is I solved all the past questions, the questions like
okay,
this, and then we'll do it together and then all that. So even this
okay,
the other time when sometime when we are having class like this, instead of doing the lecture, we now do past question paper.
okay. That's nice.
Yeah.
Thank you.
So that's what we do. Yeah. So yeah, we are looking at this guy. So we are looking at the key point. So here in this one, in the corporate financial information, these You can off your mic, please.
Okay.
This person is- So in this session here, the corporate where is that course again? This is corporate course. Is it 804? Which course is this? Okay, this is 804. We study what? Mm, Study session 2. We done here. Corporate reporting and all that. So all these things. Do it from here down to here. Financial statement and all that. So those are the things I was already talking about. Can you see all this stuff? Some of them are still, if you see the current ratio here, talk about the current assets. This is in the course material that you can check and all these things. So when we do past question paper, will be more we can see where most we can see where questions can come from, So it will help us to target those areas and solve them. And that is just like a smart way of studying. So all this maths that you see here, something we can all look at it together. So we'll just explain the concept and then we will understand the concept of what you're doing and all that. Then we'll just move on. By the time we're doing solving and all that. So this is okay. This is basically like the module one of the course. And this is like a summary, like I said, this is just a summary of that particular note. I believe that from what you have done so far, you have learned one or two things just from this summary. So by the time we are doing the solving of the questions, we actually reference the course material itself. So that if we have a question and we want to see the answer, we go back to the course material and then we see where the answer is written, and then from there we just move on like that. So this is the course material for this. So are we good? Are we together? We think we're still having another lecture today. I guess so. We're still having another lecture in another course.
Yes, you said so. I saw from the WhatsApp page. You say
Exactly.
after this.
Yeah. So we'll just do this one and then we'll stop here. So like I said, I always advise that we read our course material, please. And when you read it and you come to class like this, in a study session like this, you may have questions to ask. You can just underline some things. I have some people, like some people that doing some of our tutorial, they have questions from material. When they come to class, we just share the questions and then we answer them. So the idea is just for us to study together and then just learn and prepare for exam. Exam is in 1 month from here. We would have exam to write. I just pray that God will help us. Because, yeah, these people, God will help us.
Amen. No.
Yeah.
Amen. Amen.
Yeah. So thank you guys. We'll stop here for this one and then we'll prepare for the other course. Thank you.
Thank you so much. Thank you so much.
Sorry, please, I have a question before we leave.
Okay,
I'm
yeah,
sorry.
ask.
Good afternoon,
Yeah,
everybody.
yeah, ask the question. Thank
Please, how can I get the past questions
you. Okay, the past
for
question.
all
Rejoice.
the questions that I've sent?
Rejoice, do you have all the past questions now? Let me ask Rejoice. She may have them. She can send, but I have some. I should have 95% or 85% of the past questions. I will share. I will
Okay,
share them too.
okay,
So
okay. To the group. Are you
yeah,
sharing to the
I will
group?
share. I will send it to that group. That group then. Guys
Okay,
can read them.
okay. Thank you.
Okay. Okay. Sorry, please. The slide for this class, would you share it as well?
Yeah, sure, I'll share. So what we do is like we record our class, yeah. So we record it. So when we record and then we post, we have a YouTube channel that will post it for some person that do not join the class. They can watch from the YouTube channel. And so once we record it like this, so I'll just kind of show you guys what happened. So when we share it on the YouTube channel, we also uh, share the course material in that video, in the like the description of the video, so that if you can't, so that you can get it from there. I'll just switch to the channel and show you.
It's okay. Thank you.
Yeah. So can you still see my screen like this? Come on up.
I can see your screen.
This is taking time to just kind of smart. So the channel is ABU, LC, NBA. So this is the channel here. So this is the YouTube channel. So on this YouTube channel, can you see? So we have, if you have a video and we posted it here, I'll share this to everybody to use. Can you see this a video? So we right. So when we share the video, if you check here, can you see download the summary here? Can you see?
Okay.
So if I click on that link, it will now open the tutorial summary for me to download. Can you see? It just a link, so it will just show me the tutorial video and summary. Then I'll just go ahead and I can download it to my. I'll just share it to drive. Okay, so thank you guys. Thank you guys. And you can see the material. This is for 806. This is 806 material. So we did the me and all the stuff. You understand? So the material is just here and then you check and then you can download it. So that's all. So thank you guys, everybody. Bye bye.
Okay. Thank you. Have a great time. We'll meet again.
Yes.